Economy Channel, The Real Economy.
From Spain in 1557 to Lebanon in 2020, hundreds of countries have either defaulted on or restructured their debt throughout history. Countries can behave differently during their default. It is a complex topic and is dependent on a large number of factors. The fallout from these defaults has varied from a non-event, such as with a technical default, to a significant drop in their economy, with profound long-term effects that are still ongoing to this day. Countries have a complicated economical structure. Their economy is exposed to a wide range of factors, from political risk like corruption and mismanagement to economic growth cycles. Governments require money to pay existing debts and to perform pension and social service commitments. Country's government has a treasury department which maintains its capital and ensures the country has enough money available. Governments can raise capital in various ways, such as from increasing revenue, taxing its people and services, issuing treasury bonds, or to borrow money from foreign countries. It is probably worth mentioning that many countries have defaulted in the past. Furthermore, it is not surprising for a country to default, as happened, for example, to Venezuela in 2017, or Greece in 2015, Ecuador in 2008, Argentina in 2001, Russia in 1998, and so on. Since the 16th century there have been over 300 recorded sovereign defaults. Philip II of Spain made the first major sovereign default in 1557, and his country defaulted 3 more times due to military costs and the declining value of gold. The reason? It turns out that the king was paying some 50% annual interest on new loans prior to the default. Since then, the country has defaulted 15 times between 1557 and 1939 for various reasons. The most recent default happened to Lebanon in March. Lebanon defaulted on debt for first time amid financial crisis. The country was due to repay a $1.2 billion Eurobond, but will seek to restructure its debts in the following months. Think of governments issuing treasury bonds as borrowing loans from public. Governments pay money back periodically to the bondholder. The money borrowed by issuing bonds is known as local country debt because the bonds are issued in local, domestic currency. If the government is unstable, then you can expect the government to pay higher interest on the treasury bonds. When countries borrow money from foreign countries, it is known as foreign country debt. If the government has poor rating and is already in high debt, then the foreign countries will charge higher interest rate on the borrowed loans. When countries are unable to pay back on their loans to their creditors, then they declare bankruptcy and are then considered defaulted. Most of the sovereign defaults are foreign currency defaults. Defaults can be avoided by restructuring debt agreements and to seek help from a guarantor like the International Monetary Fund. But, as happened to Greece during the sovereign debt crisis, the guarantor can impose some strict conditions as austerity measures. Austerity has been strongly criticized by many economists. For example, the Nobel Prize winner Joseph Stiglitz has written, "Austerity had failed repeatedly from its early use under US President Herbert Hoover, which turned the stock market crash into the Great Depression, to the International Monetary Fund programs imposed on East Asia and Latin America in recent decades. And yet when Greece got into trouble, it was tried again with no success." But what happens when a country defaults? First and foremost, currency of the country can be devalued. This can make it expensive to import products. Additionally, export businesses might suffer due to selling products and services cheaper in short term. For exporters, currency devaluation is a double-edged sword. When services and products get cheaper, it increases their demand. Exports become attractive and raises competition in market. As exports are cheaper for foreign countries, they tend to buy more from the defaulted country. Additionally, domestic service providers might benefit due to foreign investments and tourism boosts, due to foreigners visiting more frequently as it happened after pound devalued in 2016. Hence default has some positive effects for the country too. Secondly, debt can be restructured, such as by extending the loan payment date, or by reducing the loan amount, or by further devaluing the currency. Austerity measures might be followed, which include spending cuts and tax increase. This leads to a decrease in living standards of people. It might start with riots on the streets leading to banking crises. The core reason for banking crises can be that the people might attempt to take all of their money out of the banks, due to uncertainty and confusion. The chances of banking crises might increase, and the government may close down its banks to avoid money withdrawal. Occasionally, withdrawal is permitted, but capital controls are imposed. Countries defaulting on foreign currency debt might also end up defaulting on local currency debt. This means that if you bought treasury bonds and the country defaults on foreign currency debt, then you might not receive your bond periodic payments. Unlike business or individual bankruptcies, assets of a country are not repossessed. However, occasionally military actions are followed when countries default. As an instance, Britain attempted to occupy Egypt when it defaulted in 1880s. Turmoil can be experienced in stock market. This can be due to uncertainty in market. No one might willing to buy anything. Many investors might even decide not to do business with the country until the situation is stable. Governments may refuse to pay any money or reduce the borrowed money, as it happened in Argentina in 2001. The country can face loss of reputation, its rating might decline, which makes it harder to borrow money in the future. But why a country simply doesn't print local currency to pay off local currency debt? Printing more money doesn't increase economic output, it only increases the amount of cash circulating in the economy. If more money is printed, consumers are able to demand more goods, but if firms have still the same amount of goods, they will respond by putting up prices. In a simplified model, printing money will just cause inflation. And high inflation creates uncertainty. The increasing inflation would reduce the value of bonds, and people will not want to hold bonds, because their value is falling. Therefore, the government will find it difficult to sell bonds, to finance the national debt. They will have to pay higher interest rates to attract investors. So, periods of high inflation discourage firms from investing, can lead to lower economic growth. Investors will not trust the government, and it will be hard for the government to borrow anything at all. Therefore, printing money could create more problems than it solves. Predicting sovereign defaults is notoriously difficult, even when things appear to be bleak for a country. For instance, analysts have warned about Japan's public debt for at least 15 years, but it still stands at more than 200% of GDP with a lower interest rate than when it was first downgraded in 1998. By comparison, many countries that have defaulted have done so at less than 60% of debt ratio to GDP. Governments tend to default for a variety of different reasons, ranging from a simple reversal of global capital flows to weak revenues. For instance, if a country devalues its currency to pay its debt, the lower currency valuation makes their products cheaper for export and helps its manufacturing industry, which ultimately helps jumpstart its economy and make debt repayment easier. But many sovereign defaults are precipitated by a banking crisis. Studies have shown that public debt grows around 2/3 in the years after a crisis, while a crisis in a rich country can rapidly change capital flows in peripheral countries. And believe it or not, some investors prefer to invest in non-democratic countries, because their policies are stable and predictable. Lenders also eventually borrow again to even the most uncreditworthy countries, because they generally don't lose everything, like in a business or personal bankruptcy. Rather, countries tend to restructure debt, albeit in unfavorable terms, and will always have assets to recover down the road. After all, a country can't exactly close its doors forever.
Economy Channel.
The key point to take away is that sovereign default can put a country into a tough situation for short term, can impact its reputation and living standards of its people. But it is not uncommon for countries to default. In fact, many countries have defaulted in the past. Country defaults tend to be very different than businesses or individuals. Instead of going out of business, countries are faced with a number of options. Oftentimes, countries simply restructure their debt by either extending the debt's due date or devaluing their currency. Thanks for watching. I hope you enjoyed the video, and if you have any questions, write it in a comment below. See you in the next video.